Hi, this is James Miller with the Investor Mortgage Insider. When I first started helping investors get loans, I thought that getting them qualified was going to be pretty straightforward. I've now funded hundreds of loans all over the country, from Portland, Maine down to San Diego, and from Alaska to Miami and everywhere in between. And what I've found is it wasn't necessarily the loans themselves was the difficult part. The biggest challenge was the investors and what they believed that even held them back from trying in the first place. So today I'm going to break down the 15 myths that I hear from investors that are keeping them from even taking the action and closing deals that they should be getting done. Myth number one: I need perfect credit to get an investor loan. So you actually don't need as good of a credit score as you might think. A lot of our clients have credit scores in the 500s. I know that sounds crazy, but there's literally products out there right now where we can qualify people with a 500 credit score. The difference is that the lenders just max out the leverage that the client is allowed to have. And generally, if somebody's in the 500s, they're going to limit them to say 50% loan to value. So what we shoot for clients, the minimum realistically is going to be like a 620. We want to be in them in the 620. It opens up the doors for every single investment property loan that's out there. Now, the thing is, you obviously want to be higher than that because of the leverage is limited at 620, right? You'd prefer to have 640, 660, 680, and so on to get yourself a higher amount of cash out or put less down on a purchase. Probably the ideal number that everybody should shoot for at a minimum is 700. You don't have to be obviously at 700, but if you have it at 700, not only does it open the door to every product that's available on the market, it also opens the door to the max leverages that the lenders will allow. And then from there, 720, 740, and so on is just gravy on top, where basically you're able to get just better terms. One other thing about credit to point out is there is a difference between a mortgage FICO score and a credit score. A lot of times people are online and they're on like a Wells Fargo or they're on Discover or something like that, and they're seeing a credit score that tells them that they have as an example, 680. And what happens is what people think that their actual credit score is different than the mortgage FICO score that we receive. If you don't know what your mortgage FICO scores are, go onto Experian, look up those mortgage FICO scores, look up the Experian 2 or the Equifax 5 score and find out what that is. So when you're speaking to somebody like myself, you'll be able to accurately tell them what your score is. Myth number 2 is I need to show tax returns. That actually couldn't be farther from the truth. Most of our clients in a year don't show tax returns. I think maybe 5 loans a year we show tax returns. We either qualify based on the rental income of the property or their business bank statements. And the great thing about the rental income of the property is it can be the lease that's on the property right now. You're renting it, you have a lease on the property. The lease can prove to show that it can cover the payment. Or sometimes we just qualify based on the market rent. I had a woman recently, she had a market rent of $1,900 a month in that area in Ohio. She was renting it out for somebody for $900. Really nice of her to do that, but we were able to basically qualify based on that $1,900 a month of the market rent. The point being is that the long as a property can prove and show that it can cover the payment, the lender would do the loan. Same thing with the bank statements. I can't tell you the number of people who have no chance of qualifying through the debt to income ratio, and they either qualify based on the lease or you have the business bank statements to show that their business is making hundreds of thousands or millions of dollars, and now we're able to qualify. Myth number 3 is I don't have enough for a down payment. So this is more for a purchase than obviously a refinance in this case, but at the end of the day, we do need a minimum 20% down on these investment properties. There are people who offer 15% down. To be fair, you generally would have to have at least a 720 or 740 or credit score or higher to qualify for 15% down. And from the lenders that I've seen offer those programs, a lot of the times those numbers just suck. And for where we're at with the rates right now here in 2025 and about to be into 2026, they're just too high for the numbers to cash flow for the property to actually cover the payment itself. And so a lot of times we're not putting 15% down. In fact, almost all my clients put 20 or even 25% down to make sure that they can qualify for the loans. Myth number 4 is I don't have enough for reserves. So reserves is actually not something we deal with too often. I do a lot of cash out refinances for people. It's just kind of what I prefer to help people pull cash out to make other moves. But when you do a cash out refinance, usually we can use the cash out as the reserve. So that's why it's not something that we deal with too often. However, if you're doing a rate and term refinance, meaning say, for instance, you're coming in with a hard money loan at 12%, and you come to me and want me to help you get out of that loan and get you into one of the lower rates that we have available on like a DSCR loan or a bank statement loan, then what happens is at that point, you do need to provide reserves. Every loan technically needs reserves. Most of the time it's 3 to 6 months. I would say most loans are 3 months, right? And so if you're doing a rate and term refinance, you would have to at least show that you have 3 months of the principal, interest, taxes, insurance of that payment. So what counts as reserves is not just money that's in your bank account. This could be a 401k, an IRA, it could be a trading account, it could be even crypto in some circumstances, but a lot of times even in crypto, they typically want to see that just maybe moved out of crypto and into cash in that crypto account as an example. But most of the time, it doesn't have to be just a straight banking account. It could be some type of other investment account to show you have that 3 months of payments. Myth number 5 is that collections or credit issues will disqualify me from the loan. So collections actually are not really my biggest concern for people. We do have one of my top lenders who does not like collections, and they make our clients pay for it. Actually, I have one person right now that they have like a $900 collection from some type of phone bill or something like that we're having to pay for at closing. There's other lenders out there that they don't have that guideline or that rule where you don't have to pay that off. So if that's the case, and it's a really like a big collection that you really don't want to pay off, not a big deal. We'll find a lender who can kind of fit within that to make sure you don't have to take that or pay off that BS bill that you paid months ago. I mean, the bigger actual credit issues, and these are kind of, I wouldn't necessarily say specifically credit, but they are things that can destroy deals. One of them is bankruptcies, obviously, foreclosures, and then loan mods. Those 3 are the big boys that we look for. If there is a loan mod, for instance, a loan mod meaning that you changed your loan terms with the lender because you were in a position of not being able to make the payments for however long. This happened a lot during COVID. People were not making those payments, and so what happened is they were pushing them off and had to get a loan mod at the end of it. If you do have like a loan mod, lenders will literally not do an investment property loan for 2 to 3 years depending on the lender. So, and that's from the time the loan mod was initiated. So that's something we definitely look out for. The other one is like a bankruptcy. People have bankruptcies obviously all the time. What they look for is the dismissal of that bankruptcy or the discharge. Once the bankruptcy has been discharged, we typically have to wait a year from that discharge date to be able to do a loan for somebody. The last one is foreclosures. Depending on the lender, it's 2 to 4 years, whether they're gonna be able to work with you on that foreclosure as well. If you're looking for somebody who's a professional who specializes in working with investors and know these loans inside and out, feel free to jump on my calendar through the link below. I would love to hear your scenario so I can build out a custom scenario for you and ultimately get you an offer that fits to what you're looking to accomplish, not some generic rate or number or promise. We're gonna under promise and over deliver for you. Just jump on my link on that calendar below. Look forward to hearing from you sometime this week. Now let's talk about the property myths, because this is where investors kill deals that should be able to work. Myth number 6 is that the property has to be rent ready. Ideally, you do have a property that's rent ready, right? That's obvious. I mean, hopefully you already have somebody rented in the property, right? You're getting a lease, you can provide me with that lease, we can run the numbers, we're all good. But that's not necessarily the case for 100% of the people. In fact, I talk to people all the time who have vacant properties, meaning they have a property, maybe they rehabbed it and fixed it up and it's vacant, or maybe they just moved somebody out and it's vacant. Not a big deal. We can finance vacant properties. The difference is we have to make sure we can get you the max leverage on the property. We kind of have to show a reason why. So if it's just vacant because you've been letting it sit there empty for the last year, well, that's a truly vacant property. In that case, some lenders will do it, some won't. The ones who do vacant properties, they typically will lower the leverage. So what I mean by that is they'll probably want you below like 60% loan to value. Now, most of my clients who have vacant properties, there's a reason for it, right? They rehab properties, they just inherited the property, they did a ground up construction, just finished the property. Maybe they put the property on the market for sale and they couldn't sell or they weren't happy with what the offers they were getting, they pulled it off. Okay, it's vacant for a reason. That's not a big deal. We can still do those properties and qualify you based on the market rent of the property without having a lease, and you still can get the max leverage, whatever, based on whatever your scenario is, so it's not the end of the world. Some properties do need minor repairs versus other properties need major repairs. If it needs minor repairs and it's rent ready, meaning maybe you have cabinets that just maybe need a little bit of paint on them, or maybe the carpet needs to be changed out, but somebody would still rent the property, that's not a problem, right? As long as you can actually put somebody in the property, minor things, not a big deal. The point is we needed to be able to pass an appraisal. What I mean by that is there just can't be major damage. We had one guy recently, the guy went in, they had foundation problems. It was literally tilted, like the ground was not how it was supposed to be. Automatically kills the deal, right? If that's the case and you have major problems, the roof has major damage, the property has clearly major damage when the appraiser is going to show up, you need to get that fixed before we go to do the loan. Because the only thing that's going to happen is if those things aren't fixed, the lender's going to have an appraiser go out there. The appraiser's going to tell us, hey, this needs to be fixed. And then the lender's going to tell you, hey, the loan's not going to be done until you fix it. So there's no reason to waste your time, my time, and everybody's time, and your money specifically. You're paying for that appraisal without knowing that you're going to get it to pass. If there's damage, there's damage. Get it done, get it fixed. Now, if there's damage and you can't afford it, let's say there's major damage, as the gentleman I talked about with the foundation issue. In that circumstance, we had to get him a rehab loan instead. Okay, he doesn't have the money to fix the foundation on his own. Instead of doing like a DSCR loan or qualifying based on the rental income of the property, which was the end goal, and what we end up getting done eventually, what we first had to do, we had to have him do a rehab loan, a fix and flip loan, right? Short-term, 12-month loan, where we go in, we get a refinance, pull the cash out. The purpose of the cash out is to pay some type of contractor the money to finish the foundation. He did that, got it done, came back to me after it was done. We refinanced him to long-term financing after. So that there is options available to you. If the property is damaged and you don't have the money, then there is options available for you to do some type of a rehab loan. Myth number 7 is that you can't finance short-term rentals. Now, this actually was the case probably, when 3 years ago when I started focusing strictly on investors, some of the lenders literally didn't want to have anything to do with short-term rentals, and there's still a few now that don't want anything to do with short-term rentals. But most lenders at this point want to do short-term rental properties. Now, there's a caveat in this. Essentially, if you're buying a short-term rental, you have an Airbnb, you want to go buy it, you're going to put your 20 or 25% down. The lenders will use something called AirDNA. What they'll do is they're going to give you a gross rent, like a gross number of that you're going to receive an income revenue over the next 12 months. The lenders are going to take that and give you 80% of that, and that's what that's the income they're going to use to qualify for your loan. So they're going to take, as an example, let's give you a number. Say it's like $50,000 on AirDNA for a property. That means that the lender is going to give you $40,000, and then that $40,000 divided by 12, that's your monthly amount that you can qualify with, and as long as that can cover the monthly payment, the lender will do the loan. The other way that people qualify for short-term rentals is that they've actually owned a short-term rental for a long time, at least a year, and they can show the last 12 months of revenue that they've generated with short-term rental to qualify. Myth number 8 is the property is too rural or has too much acreage. And we do rural properties. Rural properties are not an issue. The thing is, how rural is it, right? With a rural property, lenders will do it, but they'll typically either limit the leverage, so say max leverage with some lenders 70%, a lot of lenders do 65%. I think what makes properties more difficult to get financing on actually is the acreage part. Some lenders are 2 acres, some lenders are 10 acres, some lenders are 20. I've seen have lenders who are as high as 40 acres, but when you have like really high acreage, say 40 plus, the number of lenders who accept a 40 plus acre property is very limited. I have done one property, maybe 2 for the same client. She had like an 80 acre property. And in that case, we had a lender whose max leverage was 40, but the lender found one of their investors on the back end who just loved the property, loved the client, and trusted in the client so much that they were willing to take it on. It's very rare. As long as you're within 20 acres, we can find you a home, essentially. Myth number 9 is that if the property is listed for sale, I cannot refinance it. So this is true and not true. So yes, if the property is listed for sale, most lenders are not going to do the loan. The good news is you can remove it. If you have it for sale, pull the property off the market and then come to me and say, all right, James, it's off the market. Let's go ahead and get this loan submitted. And then the lender will do the loan because they're like, all right, this guy's off. Now, there are options where lenders will allow you to keep the property on the market, but in that case, they'll say, hey, we'll do this loan for you. It'll be a 12-month loan. We'll give you the money that you need, but we're expecting to sell it. Not a big deal. You can keep it on the market if you want, but they're just going to charge you a bunch of rates and fees and costs up front to make sure that they earn their money to do the loan. Myth number 10 is that appraisal will kill my deal. And this one's actually not too far off from being a myth. I mean, the reality is not that many properties are being sold, and appraisals are basically dictated on homes being sold. So there's not really a lot of comps. As an example, I had a client in Ohio. He sent me his property. He's like, James, can you tell me what you think the property's worth? We looked through this property as much as we could, and I was actually pretty confident in it. It had a lot of homes being sold for $355, $360. One even in the area was sold for $415 recently. So I'm like, hey dude, I think your property's probably gonna be safely around $355, $360 on this. And so we said, okay, let's go do this loan. And then sure enough, we go do the appraisal, and one of the things that just didn't show up on my website yet to show me the recent sales was a property was just sold in the last couple of weeks. And so because of that person sold that property for $305. Every other comp, every home just similar to his, $355, $316, no problem. One random guy within the last month sold it for 305, but at the end of the day, that dragged my client's property value down on the appraisal. One thing that we can do with appraisals is we can transfer them. So a lot of times we have clients who go to a lender, the lender overpromised and under-delivered. We can transfer that appraisal. The big thing is those have to be done through an appraisal management company, an AMC. That's basically because of the 2008 crash. The government set certain standards and make sure that these appraisals were being done right. And so a la came these appraisal management companies. If it's not done by an AMC, most likely we won't be able to transfer it. But if we can, it's a pretty simple process. We can use that appraisal. Appraisals have a turnaround time for about a week. We basically wait till the conditional approval comes out. We order it as soon as it does. The appraiser generally will reach out to the client within a couple of days, a day or two, and schedule it out. Once the appraiser gets to the house, we have about a week where they're allowed a week from that day that they showed up to return it to us. One of the things that we're testing out right now is we're doing rushes. Rushes are typically like a couple $100 on appraisals, but it's saving us days. So what we found is that instead of having 5 business days from the time that they showed up, it gets cut down to 2. So for some clients, we really are in a rush and we're trying to get it done faster. We are testing that out, but in general, the whole time frame from the time you order it to get scheduled and probably a week comes back, I'd say a week and a half. Worst case 2 weeks, so that's why we try to get the appraisals ordered ASAP. So in the next section, we're going to talk about how we actually structure these loans. I think there's a lot of myths about how these loans actually work, and so we're going to talk about how me and my team scrub and structure these files to make sure that they actually get to the finish line and we don't leave a bunch of money on the table. So myth number 11, I have to close in my personal name. So you actually don't have to close in your personal name. In fact, most of my clients, I'd say 90 to 95% of my clients close in an LLC. It doesn't change, the rates for these loans. What it does is give you some flexibility in terms of, when you're saying ownership, who owns the property. And this is actually a myth that we need to address right now, which is in these like DSCR loans or even these business purpose loans, a lot of people when they close an LLC, they think that the loan itself is going to close in an LLC, and that's not true. Title of the property, the person who owns the property, who's going to be on the deed of the property, like when you go look up at a county level, it will say the LLC. Somebody has to be a personal guarantee of it, so his name will be on the loan docs, but the title will show the LLC, which brings me to another myth. We're just flowing here on this one. A lot of people think that because these are business purpose loans, that they can use not their personal credit, but the credit of the LLC. That's not the case. Those would be more like maybe possibly a commercial loan would allow you to do that. With real estate or these non-QM, business purpose loans, you have to qualify based on your personal credit. Myth number 12 is DSCR loans are way more expensive than conventional loans. And as somebody who can offer both, that's just not true. Conventional loans and DSCR loans are almost identical in terms of rates and costs. Sometimes, depending on the leverage, DSCR loans are even better than conventional loans and vice versa, right? A lot of times people, when they see the cost for the DSCR loan versus a conventional loan, they're typically saying, well, I'll take the DSCR loan just because of the lack of documents. Conventional loans, you have to provide the mortgage statements, the insurance policies on every single property you own. You have to provide your tax returns. You have to provide a lot more documentation than you do on the DSCR side. That does not mean that DSCR loans do not require documentation. That's something, that is a myth, that people think, oh, this is a no income doc loan. That's not true. You are just trading out tax returns for the lease of the property, or in the case if you did like a bank statement loan, it'd be like bank statements versus the tax returns. So there are still documents you need. It's a lot better than trying to qualify through a conventional loan. Myth number 13 is prepayment penalties will trap me in a bad loan. And that actually doesn't have to be the case. DSCR loans come with a prepayment penalty. And the reason why is because you are basically telling the lender, I'm willing to trade off not providing you with tax returns and personal income docs. In exchange, I'm willing to accept a prepayment penalty. Now, as I mentioned in the last myth, this is typically on a 3-year prepayment penalty. So like a conventional loan versus a 3-year prepay, basically the same in terms of rates and costs and whatnot. Sometimes it's a little bit different depending on the leverage, but at the end of the day, they're pretty close for most loans. 80 to 85% of my clients do a 3-year prepayment penalty and are fine with it because they're not going to make any changes anytime soon. And then maybe the remaining 15% do a 1-year prepay, right? And the reason why we do that is because they want to either refinance the property in the next couple of years, they want to sell the property in the next couple of years, or they want to pay it off for that matter. Typically, by going from a 3-year to a 1-year, you increase the rate by roughly about 0.5%. And the difference in that monthly payment realistically is just not that big a deal for that flexibility, because the trade-off is typically 5% of the loan amount, 6 months interest, Sometimes it's a declining prepay, 321, or a 543 or whatever. Either way, no matter what it is, you do not want to pay that penalty. And there's just really no reason for it. So once again, have a conversation with me, have a conversation with the person you're speaking with, make sure that you express if you want that prepayment penalty covered, and they can get it reduced. Myth number 14 is hard money loans are my only option for fix and flips. This is actually not true. I'm doing a hard money loan on fix and flip right now, but that's because the woman doesn't have a lot of experience and her credit's not the best. I think she was like in the 612 range. So some of the biggest lenders in the country that do fix and flips. And you just need a couple things. One, preferably a better credit score. 680 or higher, ideal. If you do that, then you can open up the doors to working with them. They have a lower cost, better processes, they're overall better experience to work with. The other thing is experience. So how these loans typically work is if you have no experience, 1 or 2 under your belt in terms of fix and flips, they will have you put 20% down. They will provide 100% of the rehab cost. Once you get to 3 or 4, they'll put it down to 15% and provide 100% of the rehab cost. And then if you put 5 or more, they'll have you put 10% down and provide 100% of the rehab cost. The other thing is if you have just a really good credit score, say 740 or plus, they've found that those people always make their payments regardless of what happens. And so they'll let you put 10% down and provide 100% of the rehab cost. So in those circumstances, you can work with these big time lenders who utilize apps and lower their costs and keep their experience way better. Instead of going to a hard money lender, I mean, right now I'm actually going through it. It's actually painful for me to tell the client some of these costs, painful for me to go through this experience with them for this hard money lender, but she had no other options, right? And she's learning from it and she's gonna get herself into a better situation with her credit, and then we'll come back later and get her with the better lenders. But it's not a requirement to use these hard money lenders. If you have even a 640 credit score or higher, you can use them. They sometimes will require more reserves. But overall, if you're looking for fix and flip loans or rehab loans, whether you have no experience or a lot of experience, there's other lenders out there other than strictly working with a hard money guy. Myth number 15 is all the lenders are the same. Just pick the one with the lowest rate. As somebody who worked with a direct lender, who worked with on the now broker side, has access to 150 plus different lenders, I can promise you with a high level of certainty, they are not all the same. Every single lender has their own rules and guidelines. And so some of the rules and guidelines will fit really well with your scenario. Other rules and guidelines will not fit well with you at all and basically send your loan to die, right? And so working with somebody like myself who has access to all these different lenders and understands these rules and guidelines at a super high level will allow us to not only get ahead of problems, but if problems do show up, how do we pivot, maneuver, work with the lender to get the job done? I can't tell you how many times I've had clients come back to me where somebody overpromised them to give them a better rate or better terms, and then they end up changing the terms at the end, which is another big problem in my industry. There's so many people who are desperate for money to get deals done. They'll literally tell you yes just to get you in the door and then change things at the end. Taking somebody just because of the lowest rate is not always the way to go. And for somebody like myself who has 150 different lenders to choose from, how I end up choosing the lenders is based on a couple things. One, their rules and their guidelines. I think that the rules and guidelines are everything, because if they're rules and guidelines and I can make sure we can pivot and maneuver around it based on your scenario, that's ideal. Number two is the people who are working there. Like I work with certain companies that the account executive themselves that I work with a lot, very good person, whatever, but the team behind them, their underwriters, their managers, the people who are their assistants aren't the best. And so what ends up happening is we have these problems that these people can't think ahead of time to get ahead of, or we give them documents, they're not reviewing the documents, it's a mess. So ultimately for me, I look for the underwriting and guidelines. Number two is I look at the process and how they run their team and how they run their system. And number three is the people themselves. I want to have a good experience and have relationships with some of these top lenders and the account executives and the account managers and the underwriters. I want to make sure that I have a good relationship with them. So if we ever do run in circumstances where there are problems for a client, right, which comes up a lot, I can ask them, call them, hey, how do we solve this problem to get this loan to the finish line? Or maybe even there's no way to solve the problem. I just have to ask for an exception, and they will give it to me because of the relationship that I have with them. And obviously, the rates and what they come with, that speaks for itself. The rates and the costs have to be competitive. If the rates and costs are not competitive, then I just won't do business with them. It doesn't make sense. I'm not going to put my clients in a position to go with one lender versus another. And at times, if two lenders are really tight and somebody's rates, rules and guidelines are good, but the rates maybe aren't that competitive, once in a while I will ask for them to match the pricing from another lender to see if I can get them to work with them on these deals. But at the end of the day, we're looking for as good a rates as possible with the best experience overall, that it's better for you, it's better for us, and that's how we dictate who we choose from when it comes to one lender from the next. Now, I know that was a lot of myths and a lot of information, but I hope you learned something from this video, and next time you're going to make a move and do a loan, you'll have an easier experience than before. And maybe these myths that you have in your mind will help you just make a decision to move forward than holding yourself back from doing that deal. Remember, first link in the description below if you'd like to jump on a call with me to talk about how we can help you make your next move and grow your portfolio. And be sure to subscribe and like this video, and I'll see you on the next one.